Okay, let's open. We are running late, but let's open for discussions and comments. I take 15 minutes more. Roberto?
Yes, thank you. I enjoyed all the presentations, but something punctual about Pilar's talk. The Inter-American Development Bank, in fact, has looked at the data on the issuance of bonds and loans in Latin America, and they, I think, correct me if I'm wrong, in the 2014 volume, they actually presented data that suggested that the problem that you're alluding to was essentially mostly a Brazilian problem and a Mexico problem. I mean, I'm talking about the issuance of debt by offshore agents of domestic firms. So it was mostly a Brazil and Mexico phenomenon and not generalizable to other countries. In fact, for Chile, it is the opposite. I mean, the numbers go the opposite way, if I remember correctly. So I just wanted your comment about that, and maybe you should actually talk about this. One piece of advertising. Actually, this issue has become an interesting question in connection with, for example, the BIS view that was mentioned earlier in the discussion. In fact, Hyun-Shin has been particularly instrumental in raising flags about these developments. Let me just mention that there is a different view of the same phenomenon that is actually much more benign. I mean, the view would be that favorable shocks to emerging economies, such as low interest rates, that's the ones that we saw in my presentation, obviously would have meant that firms in emerging economies are bound to actually take advantage of low cost of capital to borrow more. I mean, the question there was to explain why bond financing actually increased more rapidly than bank loans. And in that, the paper that I mentioned that I wrote with Fernandez and Gulan is, I think, about the only model that might explain that phenomenon at this point.
A couple of things on Christian's paper, or at least on a couple of things on his presentation. The first one, I was kind of, it left me thinking when he said that the levels of debt service over 5% of GDP were unsustainable. Shouldn't it be, is it debt service? Is it interest service? Shouldn't it be interest service? Suppose you have relatively low interest payments to GDP, but you have a lot of debt piled up for the short term, then probably the sustainable is just a matter of how to rebalance your liabilities in time. The second aspect is in terms of can you inflate away your debt? And I thought, if you cannot issue debt in your own currency, well, of course you cannot inflate away your debt. But even in the cases that you can issue debt in your own currency, if you inflate away your debt, you may have a problem, a time inconsistency issue, because you can inflate away this debt, but then when you go back to the markets in the future, you won't be able to inflate again, or you won't be able even to place the debt under reasonable terms. Thank you.
Thank you. Jean-Pierre?
Yeah, I have a question for Pilar and one for Christian. So I found the presentation by Pilar extremely interesting. We knew about it in general terms. We're reading the BIS reports, but here we have very specific with numbers and I found it. I don't personally take a benign view of this. I mean, to have like two layers of maturity transformation or risk transformation, one taking place offshore. I think it introduces an enormous element of fragility. So I was wondering whether Pilar shares the same view, and what could be the regulatory response to that. I mean, having bonds financing FDIs offshore or having bonds financing bonds offshore, what is the regulatory response? What happens if there's a default at one stage of the chain? So I found the presentation extremely interesting. We don't have any kind of lender of last resort there, of course. We don't even know whether we have a regulator. So that was my question. And then I have a question to Christian. I discovered, listening to his presentation, that I knew much less about GDP-linked bond than I thought. It was very interesting. Am I correct? You specified it, but am I correct in thinking the main insurance it gets for the issuers is against tail risk. It doesn't insure you against normal fluctuation. And so is it worth paying a price for insuring so much about tail risk in terms of the pricing of those bonds? So that's my first question. And the second question, what is, in your view, the optimal share of those bonds in external debt of an emerging economies? Because, of course, this is a little bit of the opposite I was talking about issuing safe assets in emerging economy. Here we are issuing something which is extremely sensitive to any kind of new of information. So it has the advantage of flexibility, but it is not fully a store of value to the extent that you specified it. It may be, it has a risk attached to it. So should it be like 5, 10, 20, 25%, 30% of the external, of the issuance of the country?
There are two issues. The first is that some of these results that are based on case studies may change over time. So, for example, you are closing with a fascinating case studies of the effect of the events in the UK, and your interpretation about the reaction of the Eastern European countries. Time will tell what will be the future dynamics, and one channel that you seem to miss is that maybe these are the countries that their labor market de facto has been much more integrated with the UK. Think about the presence of 2 million Poles and the like, and labor mobility, which is part of the issue, will remain a major issue for the Eastern European countries, but more generally, a lot of these event studies, the ultimate result after a year may differ sharply from the initial reaction. The next is to Christian about the indexed bonds. In the US, this type of bonds exist for student loans, or some of them, and definitely there is a significant benefit to moving in that direction. On the other hand, in some countries, let me not name them, some of them are important, we don't trust the GDP accounting, and we don't trust the official numbers. And we are using sometimes consumption of electricity or whatever that you wish. So at the end, it may work more for student loans or for regimes that we trust the accounting and we can trust the ability to monitor it. But otherwise, I think definitely it's nice to experiment with any new direction of innovation. But it's not clear to me that it's a panacea that will end a lot of the debate. Thanks.
Alejandro?
Yeah, just, three quick points following on Joshua's point. I think the presentation had a heavy emphasis on European countries, and maybe, if you have a supranational statistical agency, et cetera, you solve some of those problems. But looking at this from an emerging market perspective, I think the measurement problems are very important. In addition, and looking at it from a Latin American perspective, you have many countries issuing local currency debt. So to what extent, between a combination of foreign currency, local currency debt, and maybe commodity-linked debt, you kind of achieves maybe the same result, given the correlations, and maybe it's easier to implement for emerging markets. So is this an advanced economy issue? And for emerging markets, would you suggest we go this route or an alternative route with a combination of other assets? I enjoy a lot Pilar's presentation, and I think a question is, why do we care about offshore issuance of debt? And then you say, well, maybe because somebody was looking at the balance of payments data, and then they didn't see something. But when you look at corporate level data balance sheet, you see it. So let's just look at corporate balance data. However, you touch upon an issue saying, okay, what are these firms doing with the resources they're collecting with debt? And there is my question. Is there any difference between the use of resources by the firms that are issuing through subsidiaries than by those firms that are issuing from their home country? So is this an arbitrage that they're exploiting, or is just a way of issuing because of legal things that I cannot fully understand. So, and finally, I think I really enjoy, Pablo's presentation with respect to this, classic view, and I think what we have seen, he presented a Chile perspective, but when we see how Latin American countries have reacted in the last year to the commodity shock and to the financial market shock, etc., it seems that the perverse dynamics that we could be afraid of due to the shocks are not materializing itself. We have had some of the largest depreciations in current history, and market, there has not been large or systemic financial vulnerabilities, as it was mentioned before. Some inflationary effects, but important, but not huge, and not kind of backward-looking dynamics in terms of the FX market, etc. So I think there's some evidence that this time around the combination of strong financial and banking system regulation, inflation targeting, and floating exchange rate points toward a classic view of letting the exchange rate do its things and minimizing the interventionist bent that maybe some policymakers might have.
Thank you. I have a lot of people, so Shahin, Javier, Andy, and Joachim. And after I close the list.
I'll be very quick. A question on the presentation by Pilar. I remember when I was looking at these things a long time ago, there were also cases of hidden assets and not only hidden liabilities. I was wondering if you had looked at that. I remember looking at this in the case of Turkey, where there was also a discussion about how large hidden liabilities of Turkish corporates were. And I remember that through subsidiaries in the Netherlands, they also have accumulated all sorts of large assets. So in the end, they were fairly hedged. And I don't know if that's the case more broadly or that was a unique case. In all the presentation discussing sudden stops, there was something that didn't come out. Well, I think it's the most important aspect of sudden stops. It's not only when foreign investors withdraw, but it's probably more importantly where domestic investors start to dollarize the domestic money supply and run. And in this instance, I think the lessons are quite different from the ones we've mentioned. I think in this instance, reintroducing capital controls can be a very powerful tool. And most countries do that, and sometimes they don't acknowledge it. The case of China now is an interesting one, where you have an important amount of capital outflows, which is in fact domestic money running away. And China, without saying it, is in fact reintroducing capital controls, or at least reintroducing outbound capital controls. So I'll be interested to have a view on the panelists of this dimension of capital outflows that hasn't been discussed so much.
Let me say to start with that one of the most important policy responses that you have to implement in the face of capital inflows and outflows and volatility and so on is, of course, to strengthen economic fundamentals. But I had the impression that there is a slightly different view when you take an overall sample of countries regarding the importance of economic fundamentals for dealing with the volatility of capital flows. In particular, I had the impression that the conclusion from Poonam's presentation is that it is far from clear that economic fundamentals are sufficiently important to insulate countries from the implication of capital flows volatility, contrary to the perception that Pablo has. And I am curious about it because in the particular case of Mexico, as some of you may be aware, the exchange rate has been hit very significantly, and I would say to a greater extent than other countries that have lower credit ratings, and that has to do to a large extent to the liquidity of the Mexican peso. The Mexican peso was one of the most liquid currencies among emerging market economies, and as a result of that, it has been used as a hedge. That doesn't mean, I insist, that I do not believe economic fundamentals are important. I strongly believe that the policy response to a situation of volatility of capital flows is precisely to strengthen economic fundamentals, no matter what. But my question is, why do you have such a different conclusion? If I am correct in interpreting that the conclusion is that there is a nuance there, that you seem to get to different conclusions on the basis of an analysis of a diverse group of emerging market economies.
Thank you. Andy?
So I like Pablo's presentation very much. It reminded me of a paper that wrote a couple of years ago with Eduardo Cavallo, Matthew Pedemonte, and Pilar Tevella, where we categorize different types of sudden stops. And so the stylized fact that we find is that the sudden stops in emerging economies before the crisis in the 90s, whatever, it's very much typified by foreigners bringing their money out, so it's sudden stops in inflows. And advanced economies had lots of sudden stops over that period, but they were sudden stops in inflows that were compensated by a return of capital by domestic. So they were sudden stops in inflows, as it were. So foreigners were taking money out, but they were compensated by the flows of residents, so they were not net flow sudden stops. And then post-crisis, emerging economies have become much more like advanced economies were, which is exactly your graph on Chile. So countries that have become integrated, that have large private sector holdings of external assets, appear now to be able to compensate any sudden stops in inflows, or at least there's been a tendency to do so, more so, with compensatory flows of residents, which is precisely what you're saying. On the other hand, advanced economies have actually suffered some more sudden stops in inflows, but concentrated very much around the crisis. So I think your presentation is sort of very much in line with the story that we told in our paper. And I think it is, as you rightly pointed out, the sort of increased integration and hence the stock of residence assets abroad that's allowing this compensatory effect, and we find a distinct order. In fact, I have a new paper which also tests this in a more rigorous statistical way, that the sudden stops in inflows are much more painful. Sudden stops in inflows, which are also net flow sudden stops, are much more painful than sudden stops in inflows which are compensated, which in most cases are not painful at all. So it goes very much in your direction. Just a quick comment on Roberto's absolutely right. In the case of Latin America, certainly the main country where we've seen a lot of corporate issuance in offshore subsidiaries is Brazil. And Chile goes the other way. You're absolutely right. If you look at issuance by residence and issuance by nationality and that difference, then Chile goes the other way. So in other words, there are more foreign firms issuing in Chile than there are Chilean firms issuing offshore, whereas it's the other way, and strongly so has been the other way in Brazil. Now, on Alex's question, I have a new paper with Hugo Penitzer and Julian Caballero, which doesn't exactly answer Alex's question, but it comes pretty close. It says that firms that have issued in dollars do tend to have more, do tend to keep more of that issuance in terms of liquid financial assets than firms that have not issued in dollars. In other words, they're using the proceeds to build up more financial assets than for real investment. So they're behaving more like financial intermediaries because their financial liabilities are going up and their financial assets are going up. They're not following the normal pecking order in corporate finance. How we start to look at the data, and this is our main result, this is basically only happening in countries with capital controls. And so our theory is precisely that firms are kind of issuing offshore to somehow evade the capital controls, which perhaps financial intermediaries cannot do. So they're behaving more like financial intermediaries in those places where financial intermediaries cannot do that for whatever reason, and most strongly when the carry trade arbitrage is attractive. So in other words, corporates are issuing offshore where the domestic country has capital controls and the proceeds from the carry trade arbitrage are strong. That's basically the bottom line.
Joachim.
Yeah, I have a small comment on Pablo's presentation. Pablo mentioned that rules and IT being one is one of the most effective ways of dealing with capital flows. However, intuitively, if you have a positive, a favorable shock, then your currency appreciates and your yields increase. Go down. And the reaction by IT is to raise interest rates in order to avoid overheating, right? And that attracts more capital inflows into the system, therefore more appreciation, which is fine if you're not worried about sector effects and that and all. But it's also it could be very destabilizing in countries in which the short-term effects of appreciation are very expansionary as you are increasing real wages. And so I'm not so sure that, without with the help of some kind of macro-prudential things such as raising reserve requirements or whatever, you're going to really accomplish that effect.
Thank you. Okay, so let's go back to Poonam.
Sure, thank you. And I have struggled with this, across several papers. And pardon me, Pablo, if I offend you. I call it small and selective samples. So, you use a small set of countries, don't even use any econometric techniques, divide countries into groups and tell us a story. I don't find it credible. But the biggest problem here is bunching in almost as many advanced economies in that sample as the emerging markets, right? I mean, they are not the same asset class. Emerging markets don't have the same privilege that advanced economies have. So we have looked at this issue carefully across papers for the same paper. We have looked at economic performance in a number of ways. We have looked at the growth forecast changes by the IMF and all kinds of metrics, and very well confidently stand by the results that strong economic fundamentals do not insulate emerging economies from reversals. They may give them more policy space afterwards, right? If you have low inflation, you can afford to ease up your monetary policy, you can fiscally stimulate, but all of those things do not insulate economies when there is a global rebalancing of assets. If anything, as you said, Mexico, of course, was affected disproportionately. So was India, and so were many other countries which were large and liquid markets. So that result stands. So if one wants to, have a horse race between our paper and another approach, then at least the sample has to be comparable. So that's on that one. On the role that domestic investors are playing in sudden stops. So two observations on that. Andy, I'm aware of your work. And our observation is that net flows do not really insulate the economies against exchange rate depreciation, bond yield changes, or stock market to the same extent. So suppose you have a sudden stop in which global investors are withdrawing money from your economy and domestic investors are bringing it back, so the net effect is small. But how your economy financially reacts depends more on gross flows rather than net flows. And I think, Shaheen, your question was slightly different, that sudden stops perhaps are triggered by domestic investors, and this point was completely opposite, that they're helping cushion the effect. Your effect, where domestic investors are equally important in making sudden stops get magnified, that is seen only in two countries, China and Russia. Capital flight. In 2015, for example, IMF's VO made a big deal of domestic investors also, going through capital flight and magnifying the impact. That impact actually mostly seen in China and Russia. Capital flight was, so that is not as widespread. If anything, the effect that Andy mentioned, that domestic investors bring back money around the same time that global investors are withdrawing is more prevalent. But having said that, bond yield, stock market volatility is not correlated with net flows. It's related with what foreign investors are doing to capital flows. I agree with whatever Joshua had to said, completely agree that stories may change 1 year down the line, and this is just some initial analysis that I showed. I think this is all there is in my notes. Apologies if I forgot to answer somebody's question.
Thank you, Pilar.
In my opinion, what I wanted to put in clear with my presentation, and I think the work of these people is pointing at, is that there is a pool of financing from outside that is not recorded in balance of payment data, which are used normally to assess capital flows, and that you have to take into account that this financing exists. This doesn't mean that anything illegal or anything bad is done with this financing. Simply, it is a risk that is bearing on agents and firms in the country, and it has to be taken into account when you analyze the exposure of the country to external financing. So this was the only thing. And what do they? I think the beauty of this type of database is that you can do a lot of analysis, knowing how the firms finance themselves, what is the structure of their indebtedness, and what do they do with this. We are trying to do this in the future, in future work, but I think Andy already mentioned some work in that direction. Trying to delve a little bit into the data. I suppose they are data very similar to the ones we use, and trying to see what do firms do with these proceeds. But we don't presume there is anything bad in financing offshore, right? And to the question whether there are information on hidden assets or something like this, I do not know. I think what they do is they relate this offshore financing to the parent firms inside the country. So in that sense, they wouldn't have any information on assets by the affiliates or the SPVs outside the country. But maybe they do. I don't know. I would have to report to the authors. Thank you.
Thank you. Christian?
Just as a starting point for our work, I think it's worth, if you have a chance, to take a look at the little citation I have from a paper from Luigi Einaudi, Debiti, from 1934. I think the problem is really that there's too much debt out there. Yeah, I mean, if you look at financial crisis or economic crisis, broadly speaking, the big crises have always been debt crisis. Just compare the dot-com crisis to the 2008 crisis. When there's too much equity and you wipe out equity, it doesn't matter. But when there's too much debt, you get a big problem. No? So I just think there's too much debt out there. And in a way, trying to extract a fixed income from entities that are subject to economic swings just doesn't make sense. I mean, from commodity exporting countries, from corporates that are tied to the business cycle, from banks, yeah, trying to extract fixed income from those entities just doesn't work. So there's not enough bank equity in the system, and I think there's not enough sovereign equity in the system. And that is the starting point of our work. You can argue that there is need for debt because you have principal-agent problems, but I think if you just look at the history, if there's one thing we can learn from the Latin American experience, is that there is a very high price to be paid from having a lot of debt, a very high price, so economically. So I think these are incomplete markets. We don't have sovereign equity, and I think that there's little to be said against the idea that there are welfare benefits from having more complete markets, which is exactly what we're proposing, more complete markets. So to Jean-Pierre's point, I think you picked up on the main issue. Is it worth paying the price, and what is the optimal share? That depends on the price. And there is a very nice article by Blanchard where he points out, Peterson Institute early this year, where he points out that we're actually facing a problem of multiple equilibria. When you only have one or two issuers, then the equity, the GDP-linked risk premium is going to be very high because you cannot diversify away the risk of GDP swings. But if you're an investor and you can hold a bundle of claims against many countries which have an uncorrelated business cycle, then you will demand a lower GDP-linked risk premium, and that will enable more of those countries to issue. So we're facing multiple equilibria, one where there is no issuance at all, and another one where a lot of countries issue at the same time, and then the premium falls. To Joshua's issue in the accounting, Well, first of all, that didn't stop the development of the market for inflation-linked bonds, yeah? And you can argue that inflation is as much a sign or an art than GDP. Second, the incentives are in favor of holders of GDP-linked bonds, and they're against the holders of inflation-linked bonds, because governments have an incentive to underplay, to basically understate inflation, which hurts holders of inflation-linked bonds, but they have an incentive to overstate GDP growth, which benefits the holders of GDP-linked bonds. And third, the way we're dealing with the problem of accounting, you know that under the system of national accounts, every 10 years you're supposed to do a GDP revision, and then you get a big gap in your nominal GDP. The way we're going to deal with that is by employing chain-linked methodology. So that deals with these accounting issues. You just do a chain-linked index, and then when they do these 10-year revisions, it doesn't have an impact on your payment streams. Fourth, on Alejandro, I think you cannot be nonchalant about the pain that excessive debt has imposed on countries, especially in Latin America. Yeah. So it's true that when you have a commodity exporter with a floating exchange rate and all of its debt denominated in domestic currency, then you can achieve the same level of protection against, external shocks, asymmetric shocks, by using this domestic debt, then using GDP-linked debt. But the price of that is that you have to employ very big adjustments of the nominal exchange rate, yeah, in order to achieve that protection, and that comes along with frictions and costs, yeah. And furthermore, there's lots of problems which are not related to shocks from commodity prices. They're domestic shocks. You have banking sector issues, all sorts of shocks out there which you cannot deal with just by having domestic debt. Yeah. So just briefly on Felipe, it's true that if you have rational expectations, you shouldn't be able to inflate away your debt. Yeah. But that does not explain why R minus G, so the nominal interest rate on the debt minus the nominal growth rate of the economy, R minus G has been negative all throughout the Bretton Woods period of the 1970s. So apparently there's more to markets than rational expectations. And on the issue of whether flows or stocks count, I would encourage you to take a look at the great work that the IMF has done in revising its sovereign debt sustainability framework, where they moved away from the stock approach to the flow approach. So I really think that flows is what matters for sustainability, not stocks. If I may, would like to make one brief comment on Pablo's presentation, which I found very good. I think that the way we're framing the problem of capital flows is still very much informed by the experience of the 1980s. This idea of capitales golondrinas, yeah, and the idea that we have lots of volatile capital flows, and we have to sort of isolate against that. Like in the case of the tesobonos, they leave, and then we have a problem. But if you look at the results of your study through the lens of a sovereign debt investor, 90% of the investments in emerging markets, domestic sovereign debt, come from indexed investors. They're indexed against GBIEM, the JP Morgan GBIEM, and this is very sticky capital. Yeah. This explains why the money doesn't leave all of a sudden, as your studies confirm. So I think we have to move away from this idea of capitales golondrinas and take into account the fact that the investors in domestic markets in emerging economies are very sticky investors. There are exceptions to the rule, as we've seen right now in Mexico, but most of the money is very sticky. And I think what we've observed recently over the last economic cycle is not so much an exodus of, a destabilizing exodus of foreign investors from local bond markets, but to the contrary, in the first time in recent history, emerging market central banks have discovered the exchange rate as a policy tool. They've deliberately run monetary policy rates which were too low compared to any estimate of a sensible Taylor rule in order to weaken their currencies. Yeah. So what we've seen here, for example, Israel or South Africa, many countries have been running policy rates which were too low to stabilize the exchange rate because they wanted to have a weak exchange rate. So I think this cycle has shown that the capital movements are not so much driven by foreign investors trying to pull out, but by domestic central banks keeping the interest rate low in order to weaken their currency and get a positive growth contribution from net trade.
Okay, running against time here. So, Poonam, no offense. no offense taken. I think that the fact that we chose deliberately the issue of what happens to local yields obviously constrains our sample to those countries that have traded by what Christian says, data on these local long-term interest rates, and that means that these are countries that already decided to be more integrated than the rest, and that obviously changes the sample. Now, there are many issues. I want to address only a few of them. There was a question of whether raising interest rates can create more capital inflows and therefore an expansionary stance of policy. I believe that can be the case only if at the same time that you raise interest rates, you are implementing policies that create the expectations of appreciation going forward, such as you raise interest rates, you put capital controls, you raise interest rates, you intervene to accumulate reserves, and you create therefore the view that the exchange rate will strengthen going forward. That creates massive capital inflows, a current account deficit, and a lot of imbalances. If you raise interest rates and you let the exchange rate appreciate, none of that happens. So the problem is if you try to tinker with the cycle of the exchange rates, and we went through that in the 90s very clearly. We didn't go through that in the 2000s very clearly because we let the exchange rate move in all directions. That also links with the idea of the role that these institutional investors or overall domestic investors play. If you lower interest rates and the exchange rate weakens, then there are expectations of strengthening going forward, and you have repatriation. The repatriation lower long-term interest rates and confirms the environment with lower interest rates in the first place. Conversely, if you have the need to increase interest rates, the exchange rate strengthens, domestic investors want to benefit from that by moving their money abroad because, for instance, interest rates domestically are going up. That again confirms the stance of higher interest rates domestically. So it becomes a sound way of adjusting to these global cycles as long as you have strong fundamentals, and I really want to stress that. There was a question on whether you could prevent capital outflows by putting capital controls. Sure you can, but if the ones that are leading are your own pension funds, are your own citizens, the efficiency and the normative implications of doing that are quite major. One thing is to prevent capital inflows from non-residents, and other things.
Clarification. I didn't mean capital controls. I meant.
No, but I was answering a different question there. So, so putting capital controls on outflows, it's very tricky, and I think at least in the current environment that we are now in Chile, it actually could be illegal because you are protecting the outflows of pension funds when they go abroad, and they will be free to leave or come back once they've done so. On the Brazil versus Chile non-residents, I think there is a very clear difference there because there's been a talk about a positioning there of for a while shorting the peso to go long in reals because both currencies can move a lot, both are commodity exporters. The difference is that interest rates in Brazil are 15% or 10% or whatever. Interest rates in Chile are 2 or 3%. And if you look at, for instance, the non-resident position in the forward market of pesos, they are shorting the peso. They've been shorting the peso for 10 years by $3, $4, $5 billion in a very structural way. Incidentally, this has a bit to do with the idea of original sin, that original sin, the solution is supposed to let the foreigners bear some of your exchange rate risk. Maybe it's not the case. Maybe you want them to short your currency so that it helps to adjust in periods of stress. I will leave it at that. There are a lot of more questions, but I think that's good.
Thank you, Pablo. Well, I think we are running late, but thank you for all our speakers for great presentations and very good discussions. We will reconvene in 50 minutes with a coffee break, and we can extend a warm applause for the panelists. Thank you.